guess in a nutshell, was the week the game stopped. GameStop, which got a lot of attention last week, declined almost 80% for the week. Investors that had to raise money through margin calls and the rest in order to fund covering shorts or whatever it was, went back to the leaders. The S&P was up almost 5% for the week after declining 3% last week. NASDAQ, similar results. Small caps up almost 8% for the week after falling 4% last week. So again, focus more on fundamentals and a great earnings season.
Yeah, and speaking of earnings season, you saw a lot of numbers coming out, and you're starting to see a lot of revisions as well. What is that starting to look like maybe for the rest of this year, given what we saw starting this week? Well,
right now we've got an 83% beat rate in the S&P 500. About half the companies have reported. And what you're also seeing is the surprises are 17% above estimate, which is very large. So it really shows that the analyst community has been very slow to reincorporate positive earnings revisions for corporations that have a lot of cash, adapted well to the pandemic, and are starting to see the operating leverage from better pricing.
Now, given all of that, though, there's some concern about potentially a derailment, and what could really derail a potential bull market?
Well, I mean, generally what derails a bull market is either excessive valuation, a Fed mistake, a Fed policy error, or some kind of geopolitical event. And right now, it's really hard to see a fundamental rationale for why we would enter a bear market. Certainly, we could have a correction at any time. We get one every 11 months, and we have almost more than doubled from the lows in March. So that's always a possibility. But the Fed continues to remain accommodative. They say they want to let the economy run hot. They don't want to tighten until that employment rate gets closer to where we were last year, which is close to 4%. We're currently at 6.3 after the most recent jobs number. So the Fed's on our side, and Biden looks like he wants to go big on fiscal stimulus. It looks like they are willing to go forward if they have to with simply the Democratic 50 votes and Kamala Harris adding her vote for the $1.9 trillion in stimulus, which is in addition to the other $900 trillion that was legislated barely 2 months ago. So that's a lot of potential firepower for the economy, for jobs, for employment, for earnings, and we are a consumption-driven society. So it's not hard to see why the economy could have a really strong second half, provided nothing goes wrong in terms of curing this virus.
But on that note, you've heard a lot about this Wall Street, Main Street, Wall Street, Main Street discussion. And where are those concerns starting to arrive from?
Well, I don't really view them as concerns. I mean, last year, Wall Street certainly outperformed Main Street. The stock market had a really good year. Meanwhile, our GDP declined about 2.5% in 2020. This very well could be a year where GDP does much better than Wall Street, right? I mean, we've already discounted some of that improvement already in the appreciation of stock prices. I'm starting to see lots of froth. We're seeing speculation. We're seeing, high valuations. We're seeing lots of call buying on the part of retail investors. We saw what can happen in the case of GameStop and Koss Headphones and the rest, where these stocks went from being nearly dead to going up to triple-digit valuation. So, I mean, anything's possible, but right now, I think you just have to go with the fundamentals and be disciplined and stick to your process.
So I think what's important, though, is understanding what you own, kind of taking a deep dive in these portfolios and working with somebody who knows exactly kind of how to build these portfolios for your plan.